Hi, and welcome back. This session we're going to take a look at equity portfolios. It is the first of a two-part section where we look at a number of topics that regard portfolio construction. We don't specifically talk about which stocks to buy and sell and how to value stocks. We just take a look in this section at how portfolio management works with equity portfolios. And we'll start off with some of the basics in this session. Now, first off, we're going to take a look at the role of equities in the overall portfolio. We know that equities do tend to add risk to the portfolio as compared to bonds and some other kinds of investments. So this is a type of risk-on posture for our portfolio. We'll take a look at the roles of passive, active, and semi-active equity investment approaches. Are we going to be stock pickers, or are we going to choose the entire index and hope for the economy to improve? We'll distinguish between these approaches with respect to the expected return from more active approaches and the type of risk that we have. We'll also recommend equity investment approach based on the investment portfolio statement that we talked about earlier and some of the necessary beliefs regarding market efficiency that are implied with that approach. We'll distinguish between the different weighting schemes that are used for the construction of share indices and how we track those indices and the type of tracking error that we also have. Essentially, equities represent a significant source of wealth. They're a significant part of most portfolios, increasingly in more risky portfolios where investors are willing to live with a certain amount of risk for a much higher rate of return. Domestic and international equity markets both provide unique and idiosyncratic types of benefit, that they're different, they're idiosyncratic, and as a result they provide diversification opportunities. Equities, along with all other types of real assets, provide a reasonable hedge against inflation, much more so than bonds, which are largely comprised of a real return and an inflationary return. And they do give us comparatively high long-term rates of return compared to especially bonds and near-cash investments. A passive approach essentially says that we're not going to be able to outperform the market by trying to select the better stocks. We're going to choose a little bit of everything, and that's based on a basic presumption that markets are efficient, that investors in the market, by continually buying and selling, will eventually identify the proper price, a process we describe as price discovery. The best then that we can do is to match the benchmark index. We try to buy a portfolio, replicate a portfolio in a way that it will match the index. The one remaining risk is that we don't successfully track that index, and of course that leaves us with a tracking risk. We have to also understand how those indices work and do that in order to understand how changes in the composition, for example, different securities being added and subtracted to those indices. We know that from time to time an index will delete or add additional stocks. For example, in the last few weeks we saw Tesla was added to the Standard & Poor's 500 index, despite the fact that in terms of market capitalization it's become one of the biggest companies in the world. It did not previously belong to that particular index. Other indices like the Dow Jones indices are particularly selective. So changes in the index will change the way that our index tracking works. These indices may also be affected by things like repurchases of shares and additional secondary stock offerings. Our purpose in a passive approach is to produce the lowest possible tracking risk. And by doing this, essentially we have no active return, no return that is attributable to the selection of particular stocks. An active approach is on the other end of the spectrum. Essentially, it seeks to outperform the benchmark portfolio through the stock picking skills of the people putting the portfolio together. Essentially, this approach is best suited to investors who believe that markets are not perfectly efficient, that we can outperform consistently the index through information, access to information, timely actions based on that information. we buy stocks that we expect are going to outperform the index and sell or even sell short those that are expected to underperform. We're not concerned with tracking risk because we maintain systematically a large amount of tracking error. We're going to be very different than the index, being significantly overinvested or overweight in certain stocks and underinvested or underweight in others. The thing that we're actually looking for is to produce that alpha, the hallmark of a successful active investor. Essentially, the portfolio rate of return minus a certain benchmark. That benchmark might be the index, or it could even be a risk-free rate. Of course, somewhere in the middle, we have a semi-active approach, also described as enhanced indexing. In this case, our investors seek to outperform the active portfolio while keeping tracking error within acceptable boundaries. It tries to build a portfolio with a limited amount of volatility based on the expected return, which is that of the benchmark. So we're trying to hit perhaps the Standard & Poor's 500 rate of return, but doing a little bit better by some active investing on the margins. It aims to produce something called a high information ratio. And the information ratio itself is described as the mean active return divided by the tracking risk. Now, talking about indexes, there are several different indices that are widely quoted, and some of these indices are actually very different in their nature. We have indices that are very simple to construct called price-weighted indices. Essentially, we weight each stock in the index according to its share price. So if we have one stock that has a $100 share price and another stock that has a $10 share price, the total value of the index would be 110, and it would put a lot more weight on the much higher price share. The benefit of this, of course, is that it's very simple to construct. The index value is just the sum of the price of one share of each stock in the index. And so we may be able to construct backwards this index, going right back to the foundation of the original companies that were in that index. Of course, anytime a company splits its shares, we have to adjust the index going backwards. And there may be additions and deletions over time as companies are added to the index, or they may be deleted because they underperform or even because they've gone broke. Index performance in this particular case is skewed towards the performance of the highest priced stocks. It would be awkward to have one stock in the index with a share price of $3,000 a share, while other very successful companies may have share prices of only $100 per share. Performance represents the overall performance of buying and holding one share of each stock in that index. And of course, the best known of these is the oldest of the commonly used indices. That's the Dow Jones Industrial Average. And you can take a look at the components, the 30 companies that make up the Dow Jones Industrial Average. If you Google it, you'll get a chart that looks something like this, and it provides a listing of those companies. You'll see that the biggest names in international business are listed here. Originally it started off, I think, with about 12 companies when Charles Dow originally produced this index, and those companies were mostly American Telegraph, American Rubber, American Steel, and the biggest companies in the United States. An easy index to create. It suited the computing power of the late 19th century. Of course, as I mentioned earlier, being made up of 30 stocks, if we have new companies that have come along and are successful, in order to add those companies, we have to drop other companies. So in this article going back a few years, you could see that in order to add companies like Goldman Sachs, Visa, and Nike, other companies like Bank of America, Alcoa, and Hewlett-Packard had to be dropped from the index. More recently, if we see a company like Apple being added to that index, which we have, of course they're going to have to find another company to drop. So this is a simple to construct index. One of the problems, though, is what happens if one of these companies has a huge share price? Well, for that reason, Apple couldn't be added to the index until it did a share split. I think it was a 7-for-1 share split, which brought the share price of Apple down to the range in which it would be seen as a reasonable component of the Dow index. Now, against this, we have value-weighted equity indices. Essentially, they work just like the price-weighted indices, except that the weighting is going to be based on the overall market value or the market capitalization of the companies that make up this part of the business. We don't need to know the share price. We have the share price times the total number of shares outstanding, essentially divided by the total value of the index in order to figure out what the value weight should be for each stock. Within certain subcategories or different variations of this type of index, they may also take only the stocks that are publicly traded or the stocks that are included in the float. Some stocks don't trade because they're held by management or the original founders of the company. So here we're only looking at the traded part of the business in order to create that weighting. The overall performance of the index represents the performance of a portfolio that buys and holds an equal value of each of the companies that are on that particular stock. And it adjusts automatically for value changes, any changes in repurchases or extra issues of shares are automatically part of that adjustment. It tends to be biased towards the performance of the biggest companies that are in that index. For example, by the year 2000, almost 1/3 of the Toronto Stock Exchange was made up of one company, a company called Nortel, that by about 2013 had already been wound up. It was completely gone. But it was so successful that it eventually became the largest part of the Toronto Stock Exchange, and every time Nortel had a good day, as a result, it looked like the entire index had a very good day. The Standard & Poor's 500 is the best known, and of course I mentioned earlier the Toronto Stock Exchange Index, the Standard & Poor's TSX Index. This index in particular is only made up of 250 companies out of a total of about 750 companies that are listed in Canada, but it does make up a very large percentage of the total value of those stocks, and so it's an excellent indicator of the overall performance of Canadian stock markets. Of course, you can see these, and sometimes they have a prefix before the stock symbol, like a hat symbol, or a GS before the S&P, TSX, and essentially those become the ticker symbols that we can follow. And we can see quoted information on a day-to-day basis. We can even get information about things like price-earnings multiples. Now, a less commonly used variation of an index is the equal weighted equity index, and essentially this one just takes every stock in the index and gives it an equal weight. So we'll take if we have 500 companies that are in our index, 1/500th would be the value of that particular stock. So they don't try to really adjust the weight. Performance then of our investment in the index represents investing an equal amount of money in each stock in the index. Of course, it would have to be rebalanced periodically because the performance differences are going to create weights to drift, to move from the original estimation. And small stocks might not be terribly useful as part of that information because they don't trade as often. A variety of stock indices that are produced and sold by companies like Standard & Poor's, but especially Morgan Stanley commodity indices, global equity indices, are available. And if you go to their website, you'll see that you can get an index for every country in the world denominated in several currencies. Specialist indices that are calculated for emerging markets, for frontier markets, for specialized commodities, even for things like cryptocurrencies. Those indices are produced and marketed by organizations like Morgan Stanley, who sell this to portfolio managers in order to be able to track the overall relative performance of their portfolios. Now, there are a couple of things that are associated with indices that are worth mentioning here. There are several different ways to buy an index, and of course the oldest and probably the best known is to use a mutual fund. An index mutual fund is essentially a mutual fund that is made up of all of the holdings in that particular index. So if the mutual fund salesperson at the bank says, well, if you'd like broad diversification, we can put you into a Dow Jones mutual fund or a Standard & Poor's 500 mutual fund. Essentially, the shareholders buy a unit or buy a share from the fund and can sell them back to the fund at the end of the day at the market closing price. So we don't have continual pricing the way that we do with some of the alternatives. The cost structure might be quite high. Typically, mutual funds that are based on indices are the cheapest mutual funds. They're the easiest to maintain, but there may be a difference from one provider to the next, and perhaps it'll be in the range of 1.5 to 2.5%, and that's the management expense ratio. Every shareholder has their own independent and separated account within the fund and is independently and separately accounted for. And shareholders will be subject to taxes even if they don't receive the gains in that particular time period. Now, probably a more efficient way to invest in indices is using an index ETF. Now, the best known of these are ETFs with names like SPY, SPY, sometimes called spiders, and those are Standard & Poor's 500 index funds. And so if the index improves by 1%, typically the ETF also improves by 1%. You can continually trade in these throughout the day. The price moves constantly as any other stock because it is essentially a stock that is fully backed by the underlying assets. So the manager of the ETF, a company like BlackRock, for example, iShares, their famous brand, will take money from individual investors. And if you want to invest in the Toronto Stock Exchange, you pay about $25 to buy one share in their ETF with a ticker symbol XIC. And they will take the $25 and along with everyone else's $25, they'll use it to buy a broad representation of the Toronto Stock Exchange, probably about 250, 270 stocks that are among those that are traded. The dealers create and redeem the shares and make withdrawals once a day at the market close. They don't need to account for individual shareholders. You have your registered stock certificates that do that. If you receive any kind of dividends, those may be automatically reinvested or they may be paid out. And essentially, they don't need to buy the buy or sell securities based on the investor cash flows, but in the long term, essentially that's what they do. Now, the advantage of this approach over a mutual fund is principally the low cost of trading. The typical ETF or an SPY ETF is about 0.25%, about 25 points. And if you're looking at something like a TSX ETF, it's closer to 40 basis points. So much cheaper than the cost of the mutual funds. Larger traders may keep separate accounts, or perhaps if you're investing into a pool account with a number of other investors, you can also create an index type investment account. Essentially lower cost because larger amounts of investment with better educated investors and overall lower transaction costs. They tend to vary in their response. Perhaps they may not match perfectly. They have higher tracking risk than some of the other investments, but they do that in exchange for the lower cost of management. We can manage these type of portfolios using a number of approaches. We can try to perfectly match the index with full replication. We can sample and partly replicate, or we can use some kind of an optimization approach, and I'll explain these in the next couple slides. We also have a number of ways to act on our information about the index. We can use futures contracts. We can use options contracts that are based on futures. Index futures are essentially futures contracts that are available, that can be purchased from somebody else who's willing to sell it through an options clearing system. Essentially, it's a win-lose proposition because whatever you gain, the other side has to lose. And these future contracts are available that can be exchanged for physicals or for the underlying stocks, with the physicals being that basket of stocks represented by the index. So the pricing, the price discovery, comes from observing the actual stock prices. Being able to exchange the futures contract for the underlying basket of stocks creates a great baseline for the valuation and reduces further the transaction costs. And it also makes it easier to do risk management. It becomes part of a risk management approach for many types of market participants. You'll see that if you go to websites like Bloomberg's, that there are a variety of different contracts available with different expiration dates, with price quotations, with the information usually about the number of contracts that have been exchanged. And so you can see, for example, looking at this page from Bloomberg, on this particular day, there was a futures contract with expiration of March, in this case 2014, with an opening, so with a closing price of 16,000 on the Dow index. You can see what the change was for the day and what the range of trading was over that day. We have a number of North American, but also some international exchange is mentioned in this particular quotation as well. You'll see within StockTrack, there are a number of different ways that you can invest in index futures. If you look under the trading link, you'll see that there are a number of different options for futures. So go to futures, inside of futures, the drop-down bar will show you that you can invest in currencies, commodities, indices, and of course you're interested in the indices. There are a variety of indices that you can invest in, including things like the Standard & Poor's 500 index, Standard & Poor's E-minis, NASDAQ 100, Nikkei indices, and so on. Once you've decided that that's the particular type of risk that you're going to use as part of your hedge, then you can look for more contract details. You'll see that inside of StockTrack, there's another drop-down menu that will give you some of the contract specifications. But a better source for these is to go to the original exchange. You'll see, for example, those Dow Jones contracts are traded on the Chicago Board of Trade. The E-minis, the Standard & Poor's 500 smaller contracts, are traded on the Chicago Mercantile Exchange. And so I can go to the Chicago Mercantile Exchange and get information about particular contracts just by following through the different steps to get this information. I have information about settlement, about the latest price, how many contracts have been traded. I've also got links that I can collect to get me information about things like the contract specification. In this course, we don't specifically go through all that detail, but I will talk in the tutorial session a little bit more about how we can look and understand these particular specifications. The purpose, typically, for using these index futures is to mitigate a pre-existing risk that we already have in our portfolio. Perhaps if we've decided that we have too much exposure to one particular market, we might want to find a way to hedge that. There are a number of techniques that we generally describe as being a normal part of finance, and essentially they always start off with an existing exposure. Now, we have shares in a particular company. Our shares are currently trading at $25, and in an ideal world, the share price is going to go up. Now, this payoff diagram tells us that if our share price goes from $25 up to $27, we're going to make $2 per share of payoff, again, per share. Now, of course, we're very happy to live with that, and if we knew that was going to happen with certainty, we wouldn't be concerned. But what if we have reason to believe that in the short term, there could be a substantial fall in the value of that stock? We're not sure of it, and for certain reasons, we've decided we don't want to sell the stock. We have transaction costs. So how can we buy insurance against the downside risk? Well, in this particular approach, by using a covered call, we're going to use a call option. And again, we don't talk about options in this course, but I will talk about them a little bit during our tutorial session. In this case, we could buy a call option on the index, and rather than talking about one share, we're perhaps talking about overall exposure to the Standard & Poor's 500 index. So we could have, we could essentially write a call, sell a call option on the Standard & Poor's index using that option approach, and combine that with our underlying physical position owning shares in the Standard & Poor's 500 index. The combined value of our contract and our underlying position would be represented by this black line. And essentially it tells us that if the price falls from our current position of $25, we're still actually going to be doing pretty well because we made money by writing the call option. We made $4 per contract for writing the call option, and we haven't lost anything yet because the price hasn't gone down. If the price drops by $1, by $2, we're going to lose value in our underlying position in the index, but we're still going to be making a little bit of money, a little bit less from the value of that written call option. And when it falls enough, eventually we would lose money. But our general expectation here, we're happy to earn $4 of premium, and that's going to be their best possible outcome. So anything to the right of our current price, we're going to have a partial gain through the rise in the index and a partial loss through the cost of the call option, the written call option. So that's a covered call. We can also use portfolio insurance, and that's an alternative hedging strategy that makes sure that we have a minimum rate of return on our portfolio while maintaining unlimited upside potential. And to do this, we put a put option together with the expected return in the underlying investment. And again, we have a question, exactly at what level is the exercise price in the put option going to happen? And that kink point in the option contract can be at the current price or perhaps in the money or out of the money, something that we don't really go into detail in this particular course. There may also be problems in exact matching of the total value of our portfolio with the exact number of contracts. So we may be slightly underinsured or perhaps a little bit overinsured. Protective put works like this. Again, we have our underlying position in shares or an index, and if the price goes up, we're going to be doing very well. This time, though, instead of the call option, we're going to use a put option. Instead of selling a call option, we're going to buy a put option. And the put option pays off when the price falls. In this case, let's say our put option costs a couple of dollars per contract. And if the price falls below $25, the value of the option becomes increasingly valuable. And largely whatever we lose as a result of the falling value of our basic investment is going to be more than matched by the call option. So our combined payoff in this case essentially says that worst case scenario, nothing happens, we remain at $25 and we lose $4 per share. But we're also drawing a line underneath that loss and says that's the minimum amount of loss that we're going to have. If the price rises, well, after we paid off that $4 per contract that we had to spend to buy the insurance, everything is profit. And so we have unlimited upside. If you think about this in terms of covering your shortfall loss, if we have a bad year, we could end up doing worse than we'd like, but not as badly as we could. So it gives us limited downside. An alternative approach to this would be to have a put at perhaps a slightly higher exercise point. Instead of it being at 25, in this case it would be at 27, and so we would have a smaller loss, or we could even have a high enough exercise price that would give us a gain, because the closer or further into the money the option is, the cheaper it's going to be. Now, this is talking about using typically options. Futures and options have similar characteristics. The main difference is that hedging with futures eliminates both the upside and the downside. Hedging with options has got that optionality. We're only going to use the option if it's to our interest. If we have, if the option is going to be significantly below the purchase price, we just walk away from it. So it eliminates risk in one direction only. We also have another type of derivative called swaps, and for this we could have an equity total return swap. In this case, we've come to an agreement, usually through a broker, through a clearing organization, typically an investment bank, with another party. Those guys are called the counterparty. And in this particular approach, the counterparty is going to receive the total return from an equity index portfolio. The party on the other side of the swap can receive either the return from a different index or a straight fixed rate of return. This was popular in the US, I think in the 70s and 80s, and it offered tax advantages and was commonly used by high tax investors. It was a way to be able to shift your allocation of assets without actually creating a transaction cost, and it was also useful for managing international tax differences. Now, a few more words about tracking an index. The most thorough way to track an index is to be the index and essentially buy all of the stuff that's in the index. Essentially, every index component would have to be owned according to its index weight. And you can see how awkward that would be. If you had an index with 500 stocks, you'd have to buy a little bit of each stock. And some stocks have very high prices, so it'd be very hard to find perfect replication. It would work reasonably well if our benchmark had a limited number of stocks that traded very regularly, something like the Dow Jones Index. And if we could use a full replication approach, we would have no tracking error. Minimum tracking risk is our objective. As stock prices fluctuate, well, then so would the actual value of our portfolio. And there should be a slight amount of tracking error because of management costs, administrative costs, difficulty with things like dividends that are paid out and have to be reinvested, which would create a drag on the portfolio because cash typically provides a lower rate of return. And of course, it wouldn't work if the assets were illiquid. Later on, we'll talk about things like real estate, which is a typical illiquid portfolio. Now, an alternative to this would be to essentially use samples from different strata or different levels. We could take a look at the largest, the medium size, and the smallest companies and say we're going to have a percentage of our stocks from each of those strata. We could take a look at 12 different industry sectors and take one piece of each of those 12, buying so much in mining and so much in oil and so much in banking. We can also use an alternative approach where we look at things like growth versus value stocks, blended stocks. And we'll do this by putting each of those stocks in a cell in a matrix, essentially trying to match our matrix of investments to the matrix that would represent the index. This would produce some tracking error, but if we're doing this reasonably well, then we'd have the minimum amount of tracking error. We'd be able to buy large enough blocks of stock to reduce our transaction cost, and that would also help us to reduce the tracking risk. Another approach is to use optimization. And sometimes we talk about this kind of optimization when we talk about factor investing. Beta is a great example of one of those factors that's used to identify a certain type of stock. In the case of beta, when we're looking at the capital asset pricing model, we're talking about the firm-specific variance relative to the market. We could also look at another beta that reflects the size of the company or that reflects the industry. So in this particular type of a multi-factor model, we're going to try to match particular index risk factors. Our objective is to reproduce the type of risk that's relevant to that particular index without actually having to buy all the stocks. And it also takes into account the relative risk of different types of factors so that the covariance will also be taken into consideration. There may be imperfect specification of risk factors and misunderstanding, and we have measurement problems with some of these risk factors, and so that may result in some remaining or residual tracking risk. And that'll take us on to the next section. In the following section, we're going to take a look at portfolio styles, but we'll save that for the next video, and I'll talk to you about that in a short while.